Hello, everyone. My name's John Elasic, and this is my course project for managing AI projects. We're going to look at consolidating financial projections or models with machine learning. So, from an opportunity evaluation perspective, the current landscape is very fragmented with multiple models uh, across the bank's ecosystem. So there'll be separate models for new accounts versus existing accounts. There are separate models for stress testing and separate models for deal analysis. And in managing all these, the assumptions are coming from the individual subject matter expertise, the analysts, across all of these different groups, and that leads to really complex version control issues as well as a lot of manual intervention to provide these handoffs across the different groups when they're needed. Because, for instance, you might need a capital analysis from the stress testing team for your new account analysis, and they would have to provide that, but they'll do it in different formats because the models aren't always in the same formats, which happens most of the time, and that requires a lot of manual work for these analysts. So the impact of this is the risk of poor investment choices and potential regulatory fines in the event of stress testing, for example, where you're unable to produce a good result. You can get fined by the government or even worse. Operational drain. Again, these manual handoffs by all of the analysts really prevent you from being able to get into granular detail because there's only so much work a analyst can do. So you might get a product level, for example, credit card or an individual product within credit cards to that level of detail, but getting to real segment level forecasts where you're talking about splitting it by demographics like age, geographic area, credit score, etc. Those are very, very difficult. It's also difficult to audit. So if there are questions about the assumptions, getting back to the one source of truth can be challenging, given all of the different areas in this spider web of handoffs that are required, and employee morale goes down because in addition to your day job, you're also managing all of these additional handoffs and incoming questions on your forecast. So the solution here is to create a consolidated model that will provide a higher level of accuracy in forecasts as well as greater efficiency. Uh, So we have to talk about whether it's better to use machine learning here or a heuristic. And I do believe that machine learning is the best option here for a number of reasons. The centralized model will be able to automate a lot of these manual handoffs and increase the forecast velocity. So the not only will the forecasts have an impact on the employees and the version control issues that you're seeing, but it'll also increase the amount of time it takes to get a forecast to senior management to make a decision due to the lack of manual effort. The prediction will be better because there'll be a single source of truth for all of the forecasts rather than working with different teams who may have their own different opinions on how these forecasts will play out in the next 6 months, 1 year, 5 years, whatever term horizon management may be looking at. And then from a personalization perspective, it would enable more granular forecasting. So you'd be able to really break down segments within each individual product to gain additional insights and to understand more at that level what's happening with your portfolio. So from a business understanding perspective, in the CRISP DM process, which is the first step that we need to go through, we'll talk about the problem statement, which I just did previously, which is financial institutions struggle with fragmented modeling systems. This creates some knowledge gaps, inconsistent results, and then as a result of that, you have poor strategic decisions. There's regulatory risks in the terms of fines. And then also all of these manual data handoffs cause inefficiencies and drain your resources. So we talked about the solution that's got the consolidated model that will improve forecast accuracy and mitigate regulatory risks and improve efficiency. The target users are your analysts primarily, but you will have some people in leadership and product or leadership as well in product, finance, marketing, and risk who would use these tools. And in the current state, with these fragmented models, the banks will have significant oversight and committees that are used to mitigate risks, but things still occur or incidents still occur, issues still occur because of the manual nature of all of these models. And it does slow down decision making and speed. And then all of the high governance touch points can lead to a lot of friction between groups. And again, you have the manual kind of operational drag on the employees as well. So really think that machine learning will help here to make things a lot better. So when we talk about defining success here and the outcome metrics, the outcome will be implementing this model that will lead to increased accuracy and efficiency of forecasts. The metrics that we're going to measure is a 20% reduction in average turnaround time from request to delivery for a forecast. And then accuracy, we'd hope to see a 25% improvement across key indicators. So that's your net assets value, forecast losses, interest income, net income. Those would be items that are need to be tracked, and where you would want to see the model perform better by at least 25%. When we think about the relevant data factors, internal, you have your data already, so your payments, your purchases, any deposits that might be made, costs for acquiring customers, and your loan performance. You also have external factors like macroeconomic indicators, geopolitical risk, credit attributes coming from credit bureaus, as well as open banking sources of data as well. You would have demographic data as terms of factors, so segment specific, including your age, geographic location, and then of course the other factor, and it's not necessarily data related, but it's just a factor to consider here, is still need subject matter expertise to inform the model. So somebody that's going to look at the output when creating and training the model, and then as well as continuing to monitor on an ongoing basis to ensure it's working correctly. And that's going to require your internal analysts that we already addressed as the key users and leadership. So the solution concept and validation plan. We had mentioned that this would be a centralized model. We would use 5 years of historical data to train the model with monthly refreshes. The other thing that we would need to do here is bring in some external data from sources that would help us with stress testing scenarios, as well as additional information on credit bureaus and or credit bureau data and open banking data. But 5 years would work, and then with the data for the external partners, you would probably be looking more at some of those big recession scenarios that have occurred over the past 30 years that would help you better forecast, if there is a recession happening, how your accounts and loans will perform. The next one is the validation plan. So we do this in 2 ways. So before implementing the model, we would back test multiple historical points to confirm accuracy. So we would use that 5 years of historical data, but for testing, we would move the start point of the forecast within that 5 years to ensure that the model was predicting accurately based upon the historical data that we're seeing and the model output itself. And then after we've decided that the model's performing well on the historical data, using the walk forward validation, we would do shadow testing, which is running all the models running the model in parallel with the legacy processes to sort of benchmark that the model's working and producing acceptable results before turning it on and fully phasing out the old process. In terms of some design decisions on how we would design the model, We would use offline learning. I think this is okay given that it would be updated on a monthly basis. We don't need it to be online learning, and there's also some review you'd want to do from a batch perspective to ensure that all the data is loaded correctly and that the outputs are working right before ensuring that you'd move the model forward into and then the updated data into production without making any changes to the model. There are a lot of scalability needs and complex financial simulations that are required, as well as calculations. So we would use the cloud for this. I don't think you could use an edge model here because it's just too big when you start talking about all the data required in order to effectively forecast for a bank the financial future. And then again, I touched on this earlier, but your batch prediction would optimize efficiency and data security for sensitive financial information, in addition to needing to be reviewed before being loaded to the model. And again, working with sensitive financial information here, somebody's what we call PII, personally identifiable information, has a lot of regulatory scrutiny around that, and that's why the batch process is better, so you can make sure that nothing is being put out into the cloud or anywhere outside of where a very small subset of people or no people would be able to view it, depending on what it is, um, so that you remain compliant with all the regulations. And then when we talk about risks and mitigations, I really see two risks here. There's the training serving skew risk, where we see a shift in historical spending and financial service preferences. And those can evolve over time, and that would render the data less relevant. So, for instance, when I say financial service preferences, I might be talking about a switch from credit card preferences to buy now, pay later, or potentially there's a new lending product that needs to be taken into account, which may skew the existing data and cause further analysis and changes to the model. And then the last one is data and concept drift, and these shifts in macroeconomics or customer mix here would definitely cause you to need to retrain the model. So, for instance, if your mix when you start the model is people who are prime and have, which means very good credit scores, but over time you start going further down in the credit score brackets, your model may not perform as well because there's different behaviors between those two groups. And then we would mitigate this by monitoring, doing monthly tests of the batch data that comes in, ensuring that the output produced is still at within the desired thresholds of what management is expecting. And that's it. Thank you so much. Bye now.